equity mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. I'm very excited for this interview. One of the, I'm going to say, most inspiring fund managers we've had on the show. One of the interviews where I really remembered why I love investing. We spoke about some of the best-known companies, the Teslas, the Spotifys of the world. We spoke to this expert last year. Obviously, some of those names have sold off a little bit from there. So we've got him back on to talk about it and hopefully get inspired all over again.
That's it. Our audience have been asking for this one, and it is our pleasure to welcome back to the studio Tim Samway. Tim, welcome.
Pleasure to be here. Thanks, guys.
So Tim is the chairman of Hyperion Asset Management. They're an Aussie-based fund manager focused on buying the highest quality companies at reasonable valuations. Hyperion manages approximately $13 billion, including, in the interests of disclosure, and my co-host Ren here, you're on the fund.
I am, yes.
Loves what Tim is doing. So no pressure, Tim, on this interview. Ren will be picking your brains. Hyperion's Global Growth Companies Managed Fund is ASX listed. HYGG is the ticker, and over the past 5 years has returned 25% per annum, beating the MSCI World Accumulation Index by 9% per annum. So yeah, it's been pretty fascinating. But we are here today to talk to Tim about what's going on in markets, and particularly the fall in some of the growth stocks in the fund, and how you're viewing it all, Tim. So Ren, let's kick off.
Yeah, let's start broad, and then we'll get into some of the specific company names. Tim, let's say you've just come back from Canada, where you weren't working. Let's say Bryce and I have been in Canada for 6 months, haven't looked at markets, haven't picked up our phones or opened a laptop, and then we come back and the market is what it is now. How would you explain, or how would you summarize what we've seen over the past 6 or 12 months?
Right. So, I think I'll go out on a limb and say we're actually now post-pandemic, even though there's cases. I think it's post-pandemic. And so there's been a plethora of demand and short-term growth as a result of all that government stimulus. The process of supply catching up with demand has resulted in shortages and bottlenecks. We've seen wages as employers chase scarce employees. It's fair to say the lack of immigration on the last 2 years hasn't helped, and freight costs have gone through the roof. So and that's added to the cost of goods. So the oil price has spiked as OPEC has restricted supply, and there's now an extra surge due to the war that's unfolding in Ukraine. So that's basically the resulting fears of a Russian oil and gas disruption. So they've caused a spike in inflation, and the fear is that inflation will get out of control. So it's fear. Basically, it's fear. It's fear of inflation. And central banks normally respond to inflation threats with interest rate rises. And, there are companies with long-term earnings growth prospects, the sort of companies that we buy. Let's group them into a bucket, I guess, called growth stocks. And these are companies that are still building their competitive positions so that cash flows will come, so, not so profitable now, but very profitable in the future. And those companies are very sensitive to long-term interest rates. So interest rates, all other things being equal, means lower valuations and prices, share prices for those companies due to the long duration of the valuation. So a change in interest rates really affects valuation much more when you're looking out over 10 years, rather than, just the next couple of years. That's sort of the compounding effect. Rather than a company like a value stock where everybody's only looking out the next couple of years and perhaps mean reverting the earnings and there's some uncertainty. We're like cyclicals, for example, a company that can do well for the next couple of years. And that's why we've seen such a big rotation from growth companies to value companies since, the end of November. But interestingly, there hasn't been a large rotation in the flows from investments into growth funds into value funds. So it kind of tells me that this is a short-term trade rather than a long-term secular trend. That is, there's a hell of a lot of people thinking there's a trade in this, let's make the trade.
Well,
I guess that would be my summary of what's happened in the last 4 months anyway.
There's always a lot going on, particularly at the moment. But look, Tim, as a long-term investor, you sort of have your average holding period of 10 years for companies in your portfolio, and you mentioned there that you're really playing in that growth stage. So how are you approaching this sell-off at the moment, and thinking about the companies that are in the fund?
Yeah. Well, I mean, we changed. Like, we're not a leopard. We don't change our spots. It's an opportunity to build positions in outstanding businesses that are being sold off on macro fears. I'd argue that a lot of it's sentiment. Well, I'm assuming we're going to get to some companies in a bit, so I'll talk to some of the results we've seen in earnings season. But I think a lot of the fears that are causing this sell-off are actually unlikely to eventuate. And certainly, I mean, some of them will. There's some steps on the way, but like not to the extent that everybody is fearing. But having said that, we've reduced our cash holds. We've invested in our strongest names for the long term because, hey, that's what clients have to do. So removing investor behaviour this is the time where sticking to your process and not getting into that natural investor behaviour is very important. So I'll talk about some of the stocks we've sold down and the reasons we've done so, and I'm sure.
Yeah. Well, Tim, let's move to, I guess, some of those individual names. But I want to frame this part of the conversation in a guide to long-term investing that we came across on Hyperion's website, titled "Investing in a Winner-Takes-All World." So as we get to the individual names, the companies that you hold in your portfolio, I'd love to sort of frame the conversation in this winner-takes-all world concept. And I guess to start with, can you explain why we're in a winner-takes-all world and how does that sort of inform your view of long-term growth investing?
Sure. So, okay, how do I put this? So in any sector, there'll be companies of varying quality. So, and normally the variances in the quality, the duration of their earnings will be taken into account by the market and express the current price. In some sectors, how one company can create a competitive advantage, a sustainable competitive advantage that creates what's called a power law relationship between it and all the other companies. And what I mean by that is it's not a term that I guess everybody would have come along, the expression power law, but it's when one participant in some particular market accrues a very substantial proportion of the market share or the revenue, particularly of a market, and all the other participants fight it out for second place. In a way, it's a bit like sport. So, say take a sport like tennis, like men's and women's professional tennis, where the same few players seem to win most of the tournaments. Most of the prize money, they get most of the sponsorships. If you actually watch a lot of tennis, you realise they actually only win by a couple of points every time. There might be a game or two in it, but the same people tend to win most of it because they've got it, and they win a disproportionately larger amount of the winnings than the loser. And it's the same principle with the companies. So identifying businesses that can become winner takes most business is essentially Hyperion's goal. And a lot of people spend a lot of time talking about network effects and platform businesses and new age businesses that use, really effectively to satisfy customer needs, particularly as a way of identifying. But actually, in spite of the fact that the network effect, for example, is very powerful, and I'll certainly talk about that. But the reality is it's about finding businesses with very durable competitive advantages. One of the best competitive advantages we find is a great product, like a very superior product, where a company is spending a disproportionately larger amount than their competitors on keeping that product ahead of the rest of the market. And it's reinvesting to maintain that superiority. And because of that superiority, they end up in a position where they attract the capital, they attract the intellectual capital, particularly in these tech, IT, database businesses. And so it enables them just to stay a step ahead. And also it gives them optionality. That is, the ability to start other businesses. It's sort of for want of a better word, it's the Amazon effect. It's like we're relentlessly trying to come up with new ideas. Oh, look, here's our Amazon Web Services. Let's start that. Wow, it's basically delivering most of the profit of the company now, that sort of thing.
So, Tim, let's take a look at some of your top holdings. And when we last spoke, Tesla was the largest holding in your fund. Firstly, is this still the case? And then do you still think that Tesla is the winner takes all?
So no change. It is still the largest holding, and that's in spite of the fact that that car manufacturers all around the world are really pushing very hard to produce EVs. They actually possess that first mover advantage, and it's not just in the car; it's actually every part of the supply chain and the car. So it's the batteries, it's the motors, it's the software, it's the distribution, it's the cost of production, the margins, and they've only just started to ramp up production. They're about to open, 2 new factories, and they've got unmet demand. That is, they're outselling other EVs just all around the world. I've just been in Canada, Vancouver. It's just ridiculous how many Teslas are driving around the city. I mean, every fourth car a Tesla. And it's the first time I've actually stood in front of Model Y and had a good look at it, because they're not out here yet. And I just thought, I love that car. That's a terrific looking car. It's like a little Model X, and it's just not a monster. So they're opening new factories in US and Texas and in Berlin, and that should help them cement their position. I mean, the work they're doing on self-driving, full self-driving, is groundbreaking. They're the leader in using artificial intelligence and cameras to use the car. So manufacturing it using some mixture of technology, LiDAR and cameras. And it's just outstanding what they've been able to produce. And the argument, this is the argument for podcasts. I must admit, I've listened to a couple of podcasts recently where Musk interviewed, and cemented in my mind how far ahead they are than everybody else, because they are they're really doing fabulous stuff. If you doubt me, go to YouTube and look up, what would you look up? Full self-driving Tesla. I think the latest beta is 10.9, and watch some of the videos of people driving around in American City with full self-driving. It's the artificial intelligence is so well developed that it can actually take into account modifications from what's actually on a map, for example. So it's reading the road, and quite complex change. If I had to summarize it, I'm not trying to be insulting to my now 18-year-old daughter because she's a fabulous driver now. But when I was teaching her how to drive, the Teslas now would be about the same level as a 17-year-old, her at about a month after she started driving. That is, most driving fine. She can drive around the town, she can do left turns, right turns, but every now and then something happens. Car parked in lane, you're turning left at the lights and they're illegally parked there, and she drives up behind it and I go, darling, that's a parked car, they're not turning left, the blinker's not on, you need to go around them. Yeah, or quick, floor it, we can get around here. That's the part they're working on. But if you actually listen to some podcasts with Andre Karpathy, who's, I think he's the senior director of AI with Tesla. So they're actually using AI to train AI with auto labeling. I mean, it's just mind-blowing how they are advancing the use of cameras and artificial intelligence. What's the point of this? Well, robo-taxis are just going to disrupt every part of the transport industry. It'll be from everything from your normal drive, your daily drive, to buses and to trains. It'll just disrupt them completely. I own a Tesla, and all it needs is an over-the-air upgrade to become a robo-taxi and work all day on my behalf. Yeah. Good luck with that one, Volkswagen.
We featured a couple of clips from recent earnings calls. One from Tesla, where Elon said he thinks that the self-driving update might be the biggest increase in asset value of any asset class in history. And then we featured the GM CEO, who thinks their self-driving taxis will be a $50 billion a year business by the end of the decade. So it's pretty exciting how fast all of this is coming down the pike. I'd
bet on Elon getting there. So.
Yeah, well, he said, I think, went off script and said he thinks it will be this year.
Wow.
So
classic. He's always
Look, it doesn't matter whether it's this year or next year. I reckon it's so close that you can almost touch it. So anyway,
now we just have to be able to afford it.
That's why we still hold it. It's underpriced in our view.
So
and that's not investment advice, just
that we're going to be speaking about a lot of individual stocks, so that's an important disclaimer to put across everything. We could talk Tesla all day, but let's move on to some of the next biggest holdings in your fund. And if we're framing this conversation in looking for long-term winner-takes-all stocks, then the next three big companies in your fund are well and truly winner-takes-all companies. Microsoft, Amazon, and Alphabet. They've taken all and then some in their respective markets. So I'm not going to ask you how they're going to keep, winning. What I want to ask you is the opposite. What's the risk when you look at those three giants, trillion-dollar companies, dominant in their respective markets? What could cause a Facebook-like 50% drop from all-time highs? What keeps you up at night about these companies?
Sure. Well, I thought this. I should correct you that our biggest three holdings today are Amazon, Block, and Microsoft.
Okay.
So we've actually lowered our weighting in Alphabet, Google. And that's because the data restrictions they're facing as a result of the changes to iOS by Apple and the privacy changes. So, but anyway, I'll keep my comments to Block and Microsoft. So the biggest risk for all of them is that they take their eye off the ball in their current product and spend too much time improving the future product, the Horizon 2 and the Horizon 3 businesses. That's going to be, I think, their biggest challenge. Now, we've seen that with Meta, and I will cover off on that in a second too, because that used to be a 12% holding a couple of years in our portfolio, and it's now a 2 and 2.5% holding.
Wow.
And the very reason it is that is because with Meta, Facebook has put too much time and effort into the future. But we might cover that in a minute anyway. But so first mover advantages and network effects are really powerful, but you can lose them if the competitors leapfrog your product or service So, we like all those three businesses for their levels of optionality, the result of ridiculous cash flows, their attraction of intellectual capital, as I said before, and their general of innovation. But they have to keep producing great current product, because I think that's the concern, for example, with Meta. Facebook and Instagram are super powerful platforms with billions of monthly active users, but focus on the metaverse may have allowed, taking the eye off the ball on the existing product has allowed TikTok, 1 billion users. So under the nose of them. So that's your challenge.
Yeah.
And that's our greatest fear, is that a business that's got a great network effect, beautifully defendable, loses trust, or and that could be the Facebook problem, or just spends too much time on the future and not enough time on the current.
So some of Hyperion's positions have been swept up in the growth sell-off. No surprises, but we'd love to do a very quick speed round where we throw out some of the companies and you let us know, one, if the sell-off has actually affected your view of the company, and then two, how they will be a winner-takes-all company in sort of 30 seconds or less, if possible. So let's start with PayPal, which is down roughly about 66%. Has your view changed? Is it still a winner takes all?
Okay, so all-time highs are starting points. It's called anchoring. That's classic investor behavior to find historical reference points and measure the current situation again. Like, really, saying PayPal's down 66% from its high is actually no different from saying it's up 155% since listing. However, for the sake of the conversation, we can agree it's fallen. Okay, and on all, you're going to ask me a bunch of these questions, so I'll draw conclusions about its future, because we can't do anything about the past. So Meta and PayPal are the only two disappointments in our portfolio in the last 4 months. PayPal lost some focus on its core business, and it was a miss on the number of new accounts. They've got a fabulous opportunity to monetize 426 million active accounts, and that includes 34 million merchants. It's got a great first mover advantage. So the future looks good, but I think the fall has much more to do with sentiment and macro factors that I referred to earlier than the terrible result. So while we've let the weight fall in the portfolio with the price fall, we're not a seller.
Well, let's move, and we won't talk about all-time highs again. But let's move to Block, now the owner of Afterpay. What are your thoughts on them? Are they going to be a winner takes all?
It's been operating in an information vacuum since November. It's been nothing. When they finally put their result out the other day, it went up 40% in a day. Like, oh, this is madness. Wow. And then it's back again. Macro factors at work. This is just, the thesis on Block hasn't changed. It's a modernization of banking, stealing market share from incumbent banks. The thesis also applies to Visa and MasterCard, although the upside is not as considerable as with Block and PayPal. And that's why we have Visa and MasterCard at smaller weights. But no, the thesis hasn't changed. There you go, under 30 seconds.
Nice, perfect. So we've spoken about Meta, a company that splits our opinion in the group. So let's just move to Spotify.
Well, I should say on Meta, They need to bring their focus back to the advertising business. They took staff and moved them to Reality Labs. They need to keep focusing on the rivers of gold, which is advertising. Keep going. Sorry, I felt like I should tell you that one.
Good commentary. So another one that's been making headlines, Spotify.
Love Spotify.
Nice. Well, that's all you need to say. What are your thoughts?
I mean, look, that was a surprisingly good fourth quarter result with good user growth. The margins were improving. Revenue was up 20-something percent, 23, 25%. Monthly active users up to 400 and something, I forget the number, 405, 406 million active users. They're on a target to reach 1 billion users. All the signposts are good, no change to our view.
Nice.
Yeah, and then the final one that isn't really present in our lives in Australia, but gets so much buzz in, I guess, the investing world, Roku. What are your thoughts?
So the shift to on demand from linear or physical content continues, and Roku sits at the heart of that. Its competitive advantage is largely derived from the data it collects. And seriously, it can deliver advertising based on age, sex, where you are, what you're watching. That's really powerful. It's the market leader by a big margin, and the data keeps it there. No change to our thesis. The drop is sentiment.
So, as we said, plenty of lesser-known names, some smaller holdings that aren't often spoken about in the Equity Mates community. So let's have a chat about those. A company we'd love to start with is Intuitive Surgical, which is one of the coolest $100 billion companies that few people have actually heard of. So can you tell us a bit about the company?
Well, you'll only start hearing it if you're a man of my age, when you start thinking about things like prostate cancer and, the stuff that you don't want to think about. The thematic is the modernisation of healthcare. It's basically improving surgery and surgery techniques. It enables physicians and hospitals to improve outcomes for patients. So it's robotic surgery. They've got a product called Da Vinci. It lowers the total cost to treat each patient episode. It's a robot technology. It's got better imaging. It takes out the tremors from, like, a surgeon has tremors. It takes all of that sort of stuff out. It's ergonomically designed, so the surgeon doing difficult surgery doesn't need to be in a weird position to do it. They can actually stand comfortably looking at a screen, and the system does it. And it does it through a smaller hole, better outcome. Like, it works for the patient, better outcome. It works for the surgeon, better outcome, and the hospital gets more successful outcomes, and lots of health funds pay hospitals on good outcomes. That is, they penalise them on bad outcomes. It's got a first mover advantage. What else? I mean, it's got 9 million procedures head start on its competitors. Like, most of its competitors don't even have FDA approval yet, and won't for a couple of years. It's already got hundreds of these units sitting out there in training hospitals, training surgeons. Like, there'll be surgeons who will never use anything else because they've been trained on it. That's just a wonderful first mover advantage in our book.
Wow. And if people don't know what we're talking about, it's definitely worth a Google image search, because it's pretty crazy to look at. It's
outstanding.
Yeah, it's a base.
They do some other things too, but that's the big product. They've got another one, but I like that. Like, you don't have half an hour on this.
No.
Oh wow.
We are. Bryce has clearly just Googled. Look, we do have a lot to cover, but when we were looking at Hyperion's portfolio, one of the interesting things we found was that, well, I guess we assumed, was that you have a clear thesis on luxury goods. Hyperion owns Hermes, Kering, and LVMH, three of the biggest luxury goods retailers in the world. So can you talk us through your view on luxury goods?
So it's just built on the structural demand for luxury products. I mean, the reality is it's very resistant to cycles. They produce very high quality products. They've got decades of experience doing this. Some of their products are aimed at a social set that are really the top 1%, and you may or not be aware that the top 1% of American wealth is greater than that owned by the bottom 90. That's a bit scary. Yeah, so the gap in the wealth hasn't been this large since 1927. So the uber rich spend their money on luxury products, and it's very resilient. We sold one We sold one company during the start of the pandemic, Moncler, we owned. We just felt, to summarize, I mean, it's lots of reasons we sold it, but, $1,600 US puffy jackets probably weren't going to sell well in the middle of a pandemic. But the reality is that hasn't been the case with, Hermes, that produced handbags that cost 30,000 euros.
It's crazy.
It's unbelievable.
It's crazy.
I mean, they're collector's items, and women line up for them. Yeah.
It's a whole.
And often they sell multiples of the purchase price if they're rare, because you just can't walk into a shop and buy them. You go, and it's a bit like Ferrari, except we sold Ferrari too because we just didn't think they got their head around the ESG component, which is you're just going to be able to build your business on internal combustion engines for the next 20 years, because most countries will start phasing them out in 2030. California, for example, I may have this wrong, it's either 30 or 35, it's basically said no more internal combustion engines. Like, what are you going to do there? I mean, Ferrari without a petrol engine? Can't see it.
No.
Well, I'm sure we will say
they're not going to shut up shop. They'll have to
Surely.
figure something out.
Yeah.
Yeah, I mean, they've already got hybrids, but it's challenging. So, our view is we don't want to be in a company that can have a permanent step down in the value of its capital because we've missed some company changing moment. And Ferrari, we saw that potential, but I don't see that with these ones. They're not big weights in our portfolio, by the way. Their prices have held up so well. They're at very full valuations in our mind. So they're sort of 2% holdings each, not like Tesla, which is at 12.
So another thematic that Hyperion appears to be pretty bullish on is payments. We've spoken about Block, but you own both Visa and MasterCard. So why is this theme appealing, and how remote do you think the risk of crypto and blockchain is to disrupting the payment rails of Visa and MasterCard and their market positions?
Right. Well, we've looked a lot at blockchain, but it just doesn't have the processing speed to handle the number of transactions. I mean, I'm a big fan of blockchain as an idea. It's really clever, but its processing power is measured in the thousands of transactions a second, and Visa and MasterCard need millions a second. Until computers catch up, it's not a goer. PayPal and Block have added crypto, but the margins are ridiculously small, and so it's not a big contributor. I can't see Visa and MasterCard adding crypto. I mean, I don't know. It's not. I don't know enough about what their innards look like to give you that insight. It's their rails. They're terrific in what they do. I think both of them will be glad to see customers travelling again, because that's where they make most of their money. Certainly, they made a truckload out of me in Canada. Every time you slap that card down, they just smash you. So that's where they make their money. Yeah.
Yeah. Bryce had to find a way to shoehorn crypto into this conversation. Look, Tim, we could keep speaking about growth stocks all day, but as well as Hyperion, you're also interested in, I guess we've grouped them as alternative assets, but agricultural land, carbon, and so we wanted to sort of spend the last few minutes of this conversation talking about that. So you chair Packhorse Pastoral, a fund that is looking to acquire, I think, now correct me if I'm wrong, 2 million hectares of agricultural land over the next 5 years. So
correct.
Can you just talk to us about this work? Why agricultural land, and how are you going on the journey to 2 million hectares?
Sure. Do you know who owns lots and lots of agricultural land? Billionaires. Why?
Yeah.
Because it's grown at a compound rate 7 to 7.5% per annum for the last 20 years. And actually, if you take longer periods and you go back and slice it into any 10-year period, you'll get somewhere about 6 to 7%. That's before the yield. That's just the underlying value of the land. Why? Because the product is in demand as the world population grows, and countries in Asia take people out of poverty into middle class. They demand access to high quality food and protein. And the demand for clean green product from Australia is there. So, but the sad fact is, over the last 100 years, and actually longer, 200 years, we've mistreated our agricultural land. Not out of any malice. What we've done is we've brought over the management practices that we used in the UK, where it rains just about every day of the year. And we've just overused fertilizers, and we've had lack of regard for soils. And our focus is just on the farmland that we can rejuvenate and regenerate by using natural practices. They've been proven. This is not voodoo. Changing the way that you graze the cattle. We just add capital to business to properties that are degraded, and frankly, it makes a huge difference. We can increase the number of cattle we run on it on each property, increases the yield, and it increases the value of the property. It's a property play, but the nice part about it is if you do all these things right and you follow the formula, you will also add more grass and more leaf through photosynthesis puts more carbon dioxide into the ground as carbon, soil organic carbon, and the government pays you for that as well in the form of Australian carbon credit units. And last year they were trading at $14 a unit, and today they're trading at 40 something a unit, having recently hit 60. There's real money in this in the future. I mean, carbon's a longer burn story, but certainly the property play of buying cattle properties is actually good for the environment. And cattle burp methane, by the way, so we're adding legumes that actually reduce the amount of methane, which is a very active greenhouse gas. So that's part of the process, is to reduce the emissions, but also get carbon into the ground and undo the damage that we've done. In the last 100 years, we have unsequestered, if that's the word you can use, millions of years worth of sequestered CO2. And what did we expect? Like, there would be no consequences? It's called climate change. So we need to stop emitting the carbon by burning fossil fuels, but we also need to undo the damage by getting the carbon dioxide back into the ground.
So, Tim, for those of us that can't buy or can't quite afford agricultural land or don't own agricultural land to get carbon credits ourselves, there are ways.
Why we have a fund.
Yeah, well, I was going to say there are ways for retail investors to access it. Your fund, there's some listed agricultural plays. One of Bryce's best investments of last year was an ETF tracking the carbon price. For people like Bryce and I who are interested in, I guess, the investment opportunity that comes from these decarbonisation initiatives, how do you think about some of those options, and are there any sort of watch outs for us as we navigate this world of alternative assets?
Absolutely. So the first starting point is self-education. It's new in terms of the carbon sequestration component. Packhorse has registered, is the right word, the largest soil organic carbon project in Australia, and it's only on 13,000 hectares. So it's only just nascent. But I encourage you to read wherever you can on this. There's some books that are worth reading. There are plenty of articles. Go to our website. We've just got loads of white papers and interesting information there to have a look through. I mean, by the way, Packhorse Pastoral Company is an unlisted public company, and investments are only for sophisticated investors. So it's not just a standard retail product. I show that up front. But there's plenty of education. We run ESG seminars where we talk about what this is doing for the future. And I just think it's worth educating yourself. Climate change is going to come and hit us between the eyes in the next 7 years. I know everybody talks about 1.5 degrees and 2 degrees. I mean, I get this all the time. What difference does 2 degrees make? But they're average temperatures. the last ice age we had, the average temperature dropped 4 degrees and there was 2 kilometres of ice above Manhattan.
Wow.
I just let that sink in. So average temperatures do count because it creates massive changes to the weather as opposed to the climate, you know. So isn't any wonder we're having 1 in 1,000 year floods. This is all part of the whole process. So please educate yourself. I mean, that's all I can get people to do is start reading as much as you can. This is going to be a hot thing. I mean, I will make one point. I also chair a bit called Emmy, which rates public companies on their global carbon efficiency. And the one statistic that jumped out of me when that business was looking at global companies is that the trillions of dollars of unpriced carbon risk that's sitting on balance sheets all around the world. That is businesses who are carbon inefficient, and when border adjustment mechanisms or carbon tax finally come in, as they will, they must, will go broke.
Yeah. Wow. Well, I think the second half of
Sorry to end on a negative, but there's money to be made in this. Follow the money. Why did Mike Cannon-Brookes and Brookfield make a bid for AGL? They didn't do it for the fun. It's a good idea and very good for the planet, but I'm sure they did it to make money as well.
Yeah, I mean, the second half of this conversation, talking about, you know, the existential risk of climate change, definitely puts the first half of the conversation when we're talking about what software companies are going to win in perspective. But I guess if we tie the second part of that conversation back to the first, you're obviously incredibly passionate about using investor resources to drive climate action with Packhorse. But how do you take that passion and then apply it back to these software companies and these growth companies you're looking at? When you think about companies like Spotify and Roku, who are software companies online, how does that analysis work? How do you think about that?
They are ridiculously carbon light. So if you're going to invest in things, have a look at the efficiency of their carbon footprint. Now, that's not to say, I mean, I'm not the sort of person that says never invest in another fossil fuel company. We need fossil fuels. If you shut them all off tomorrow, millions of people in the Northern Hemisphere would just die from cold. So clearly you can't do that. It's got to be a staged process. And some of them will make outlanders over the next 10 to 20 years, and they'll be the really efficient ones who can suffer a carbon tax because they're so efficient in using their carbon. This is something investors need to educate themselves about, because there will be real money to be made on one side and massive amounts of money to be lost when that carbon risk gets priced. In our portfolio, we have a very carbon light portfolio that is very carbon efficient. Most of the businesses we've gone today have very light footprints when it comes to carbon. And we think that's super important. That's a standard tenet of Hyperion's process, is to understand the carbon intensity of business that they invest in.
So Tim, I'm going to throw one question at you without notice, and completely fair if you don't have an answer front of mind. But when you were speaking about that billions or trillions of dollars worth of carbon risk sitting on balance sheets, I wonder, is there a company that has a lot of this carbon risk, this climate risk, that might surprise us, that you wouldn't expect to have a lot of that carbon risk sitting on their balance sheet, but when you look under the hood, it really does?
I'll turn it back on you. So I'll give you an example. So we've looked at companies like Santos, Woodside, they're in fossil fuel. They've got real challenges.
Yeah.
But there's a business called Saudi Aramco, which is ridiculously efficient because it's large, it has no debt, and it's efficient, and it runs pretty well on that.
Really?
So that's why you've got to look. It's like you could just put every petrol company into a pot and say they're all rubbish, and yet there's one that actually rates better than half the businesses here in Australia that aren't in the fossil fuel industry.
Wow.
We would not have expected that.
Well, there you go.
No, few people do.
Well, Tim, we have reached the end of our discussion today, so thank you so
What a
much.
shame.
Wow, look.
It's just getting interesting.
Don't say that. Well, there's plenty more opportunity to come on the show, that's for sure.
There's always
the
next
content
time, yeah.
train never stops, and we've got some exciting things coming up later this year that we would love to hear comments and involve you in. So this won't be the only time this year, and but we do appreciate you jumping off a plane and speaking to us. I'm sure feeling a little worse for wear after all that jet lag. So thank you very much. It was a lot of fun.
Absolute pleasure.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.